Have you ever looked back at your financial journey and asked yourself, why do I work so hard, save so carefully, yet never feel truly secure? I've met so many people like that, from successful entrepreneurs to early retirees. Everyone once thought they were doing the right thing until the market turned its back, or inflation quietly ate away at the value of what they'd spent a lifetime saving. A friend of mine, an engineer from Texas, once said, "I'm not afraid of losing money from a bad investment. I'm afraid of losing faith in the future." And honestly, that thought stayed with me. To me, investing has never been a race to be the richest person in the room. It's the art of keeping your cash flow positive, your mind calm, and your sleep peaceful. There are 5 principles I've repeated throughout more than 20 years in finance. They're not get-rich-quick tricks. They're a compass to help you stay steady through every market storm. Principle number 1, always keep your cash flow positive. Sounds simple, yet you'd be surprised how many people invest using borrowed money. I once met a young investor using margin to accelerate growth. When the market dropped 15%, he didn't just lose profit, he lost opportunity. I told him, don't let debt decide when you sell. Let your logic do that. Positive cash flow isn't just a number in your account. It's the foundation of freedom. When you're not under pressure to pay back loans, you can make rational decisions, not emotional ones. Principle number 2, lower your cost basis with a plan. You'll never know the exact market bottom, but you can spread out your investments. Buy gradually, a bit each month, a bit each quarter. That's how you average out risk. I always tell my students, don't chase the best time to invest. Build the right habit. Markets rise and fall, but good habits keep you steady through every cycle. Principle number 3, always keep an emergency fund. You can read 100 books on investing, but without at least 6 months of living expenses saved up, you'll never truly feel secure. Because when crisis hits, the one with cash has options. While others panic sell to survive, you can buy quality assets at a discount. That's not just a financial strategy, it's a life strategy. Principle number 4, hold quality assets and be patient enough to let them grow. The financial world is like a forest. Some trees grow fast but fall with the first storm. Others grow slowly but root deeply. Good assets, like hardwood trees, take time to mature. You may not see their price rise immediately, but their intrinsic value is growing every day. A port operator, a clean energy firm, a solid chemical manufacturer, these are the hardwoods of the market forest. Principle number 5, never invest with borrowed money. I understand the temptation to double your opportunity. We've all felt that. But debt is a double-edged sword. It can magnify your gains, but it will destroy you faster than you realize. I've seen CEOs crumble after one bad leverage decision. One told me, it wasn't the market that beat me, it was my own greed. That's why I believe investing isn't a game of intelligence. It's a test of patience and discipline. Remember this, investing is not just about money, it's about mindset. If you're constantly guessing, inflation, policies, volatility, you're letting your life be ruled by things you can't control. But when you master capital management, you don't have to guess. Whether the market goes up or down, you're fine. Like a sailor who knows he can't control the wind, but can always adjust the sail. Imagine this, 70% of your assets are in cash or savings. Safe, stable, peaceful. The other 30% are in long-term value investments. Even if inflation eats 5% of your cash value, your investments only need to return 15 to 20% to stay ahead. That's not magic. That's the math of calmness. And the best part? When the market crashes, you're not afraid. You have cash, you have vision, and you have time on your side. Sometimes we don't need someone to tell us what to buy or sell. We just need a reminder. Don't let the market make you lose your mind. If you're still feeling anxious, start by managing your capital wisely. Let every dollar you earn, no matter how small, reflect your calm and wisdom. Because in the end, investing isn't about beating others. It's about mastering yourself. Part 2. Capital structure. In any economy, 70% safe, 30% growth. You know, after years of advising business owners across the US, I've realized something. What worries them most isn't how to make more money, but how to make sure their money doesn't lose value. We're living in a time when the dollar quietly weakens. A $100 bill today doesn't buy what it did 10 years ago. Inflation is like slow-moving water, silent but powerful enough to erode everything over time. You might not notice it day to day, but you feel it after a few years. When your grocery bill doubles while your savings stay the same. A doctor friend of mine in New York once asked me, "I earn well and save a lot. Why should I invest?" "Investing is risky." I smiled and said, "You're right. Investing carries risk, but not investing guarantees loss. Just slower." That's the truth. You can't eliminate risk, but you can choose the kind you're comfortable living with. I always teach my clients one simple yet powerful rule: 70% safe, 30% growth. That means keep 70% of your assets in cash or savings, easy to access, safe from loss. Invest the remaining 30%, not by following trends, but by following a strategy. People often ask me, why not invest more? I could make more. And I tell them, sure, but I want you to sleep better. When 70% of your wealth is in the safe zone, you don't have to guess the market. You don't care whether the Fed raises rates or NASDAQ turns red or green, because you know, even if the market crashes, 70% of your wealth stands strong. Now imagine this. You have $100,000. You keep $70,000 in savings, $30,000 invested. If inflation is 10% and your bank gives 5%, you're losing 5% in purchasing power, about $3,500. But if your investments earn just 20%, you've made $6,000. That's a net gain of $2,500 above inflation. You don't need to beat the market. You just need to preserve your wealth while letting it grow slowly and steadily. That's how truly wealthy Americans live, not through hype or luck, but through the math of calmness. And here's the best part. This structure gives you the greatest opportunity when the market crashes. I still remember 2020 when COVID hit and US markets dropped nearly 30% in weeks. Most investors panicked, sold everything and ran. But those with 70% cash, they stayed calm, watched, waited. And when quality stocks were down 40 to 50%, they quietly started buying. 2 years later, they were the biggest winners. Not because they were smarter, but because they had capital and patience. Many people chase trends, gold, real estate, stocks. But if you look deeper, you'll realize every trend has a cycle. The only thing that never goes out of style is a safe capital structure. A 70-30 setup won't make you rich overnight, but it ensures you'll never have to start over from zero. And that, to me, is priceless. I often tell my older clients, especially those nearing retirement, your goal isn't to maximize profit anymore. It's to maximize peace of mind, because money only matters when it helps you live calmly, not when it keeps you awake at night. And remember this, if you can go 10 or 20 years investing without a major loss, you've already beaten most people. Of course, 70-30 isn't absolute. Younger investors might prefer 60-40 or even 50-50, depending on risk tolerance. But the core philosophy never changes. Keep enough safe capital to survive and enough growth capital to keep dreaming. Talking about capital management may not sound exciting, not like those stocks up 200% overnight stories. But believe me, the truly wealthy don't ask, how's the market today? They ask, if it crashes tomorrow, am I ready? And if your capital structure is solid, the answer will always be yes. Before we wrap up, take a moment and ask yourself, if the market drops 30% tomorrow, would you need to sell to pay off debt? If inflation hits 10%, would you still have enough cash to live comfortably? If your answer is yes, I'm fine, then congratulations. You're investing like a pro. If not, maybe it's time to sit down, review your capital structure, and ask one simple question. Am I investing to get rich fast or to stay wealthy for life? Part 3. Topic: the upcoming market and what you should do next. You know, the stock market has never been a place for the faint-hearted. It's where the emotions of millions of people collide every single day. Fear, greed, hope, disappointment, blending into one chaotic symphony. But within that chaos, there's always a rhythm that only the calmest minds can hear. I remember one morning not long ago, talking with a CEO in Chicago. He told me, "I'm not afraid of the market going down. I'm afraid of losing my composure when it does." And I understood exactly what he meant. Because when the market crashes, it's not the numbers on the screen that make you lose money. It's your reaction to them. Lately, many people have asked me, do you think the market has bottomed? Is it time to buy? My answer is always the same. Don't try to predict the bottom. Prepare for both scenarios. When the market falls sharply, it usually goes through three stages: panic first, then stabilization, and finally a rebound. But that rebound isn't always the start of a new bull market. Sometimes it's just a short breath before another leg down. I often compare the market to a person who's just suffered a major shock. After a hard fall, it doesn't stand up right away. It needs time to steady its heartbeat, to catch its breath before moving forward again. So what should we do during this phase? If you're an investor using debt or margin, the wisest move right now is to reduce your leverage, especially during technical rebounds. Those short-term recoveries are opportunities to cut risk, not to expand it. I've seen many investors fail simply because they mistook a rebound for a rescue. They doubled down using borrowed money, hoping prices would return to their old highs. But the market doesn't care about anyone's hope. And when prices dropped even further, they were left with no choice but to sell at the bottom. If you're in that position, treat any rebound as a gift, not an invitation. Use it to pay down debt, rebuild safety, and give yourself the peace of mind you deserve. Now, if you're someone sitting on cash, this is your moment to watch and prepare. And I emphasize the word prepare, not jump in. When the market turns pessimistic, when everyone sees only risk and forgets about value, that's when real opportunity begins to form. But opportunity doesn't announce itself with noise. It hides quietly inside quality companies that are overlooked. Businesses still performing well, even in a stormy market. That's the essence of value investing, recognizing worth before the crowd does. I remember back in 2009, after the financial crisis, a close friend of mine, a financial advisor in Boston, bought shares of a major shipping company when everyone else believed the industry was dead. 3 years later, that stock was up over 400%. He didn't buy because he predicted the future. He bought because he understood the business, and he had cash to wait for the right time.